This is Nightly Business Report with Tyler Matheson and Susie Gehring.
Pressure point. Stocks yo-yo on concerns over financial stress in Europe and weak economic data from around the world. Is global growth faltering?
Online opportunity, why the increase in cybercrime could become a growth area for the insurance industry.
And house call, how technological advances in medicine are bringing a whole new meaning to the term. We start a two-part series on telemedicine. All that and more tonight on Nightly Business Report for Thursday, July 10th.
Good evening, everyone. The stock market's closing numbers don't tell the whole story of what happened on Wall Street today. It was a pretty bleak morning, with the Dow plunging 180 points at the open, but then rebounded by the close. There was nothing normal about the volatile trading session today. Investors dumped stocks on scary news from Europe about the financial health of a big but relatively little-known bank in Portugal. Banco Espírito Santo had missed some of its debt payments that stirred up worries of a repeat of the European banking crisis from a few years ago. But then comments from many market pros here in the U.S. all day long reassured investors that the fundamentals of U.S. and European markets had not really changed, and stocks made a U-turn. By the end of the day, the Dow lost 70 points and NASDAQ was off 22. The S&P slipped only 8 points.
Today's losses on Wall Street followed a big sell-off over in Europe, not only because of worries about the health of Portugal's financial system, but also on a slowdown in manufacturing across the continent. That renewed concerns about just how far Europe and its banks have come since the financial crisis. Karen Cho has more now from London.
It was a day of fear and contagion for European markets as investors were spooked by strains in Portugal's banking system and weak economic news. Industrial production in Italy slumped 1.2% in May, adding to woes this week about a soft patch emerging across the region. We saw the steepest falls across on the FTSE Mid and other peripheral markets. Now, the old fears flared up around the level of debt in European banks. At the epicenter, Banco Espírito Santo, the stock falling, as you can see, on markets. Now, the holding companies of the powerful banking dynasty that created the lender are struggling to repay debt, and today delayed coupons on short-term loans. The intricate web around these holding companies in questions have reminded investors just how opaque Europe's banks are. Banco Espírito Santo's stock tanked double digits. It was suspended intraday, but has now lost more than 50% so far this year. The pain extended, though, to credit markets as well. A cocoa bond for Spanish bank Banco Popular was also scrapped today because of souring sentiment. And a sell-off in peripheral European bonds weakened demand for Greece's new issue of 3-year bonds, despite high hopes. It's only the second time it's tapped markets since the international bailout. Well, today's washout on equity and credit markets has again raised questions about just how far along the road Europe has travelled to repair its banking system. For Nightly Business Report, I'm Karen Cho in London.
But the concerns stretch beyond just Portugal. As Steve Leisman tells us, weak economic data across Europe and in Asia has some wondering if we're headed for a world of worry.
In the World Cup of economics, suddenly it seems like all the big teams are losing, except one, and so far, that's the United States. A bevy of deeply negative data from leading industrialized nations sent world markets into a tailspin today. Machine orders in Japan plunged nearly 20%. Economists had forecast a slight gain. Exports in China disappointed, and industrial production in Italy, France, and Germany have all come in with worrisome declines. Meanwhile, the fallout from Portugal's Banco Espírito Santo renewed concerns about trouble in Europe's banks. JP Morgan's Bruce Kasman says some of the data appears worse than it actually is because of a few extra holidays during the month. But Kasman says it's still not pretty.
Europe, I think, is the key issue right now. We've been thinking Europe could grow 1.5% to 2% this year. First half of the year is averaging now probably no better than 1. So that disappointment to me is what I really want to keep my eye on as we look forward.
And then there's the U.S. Jobless claims fell more than expected and now hover just a shade above their best level since the recession in 2008. In fact, they're actually running at quite normal levels. This follows the strong June jobs report announced last week. The question is whether the U.S. can prosper if key trading partners are weakening. Half of the economy's contraction in the first quarter was the result of a plunge in trade. And shrinking Chinese exports and machine orders in Japan, where the U.S. sources a lot of its goods, raised questions about U.S. spending and investment.
There's no doubt in my mind that it's going to be hard to get a U.S. economy to grow as fast as we would like it to be growing, which is well above 3%, unless we have a global economy that's doing okay.
That's a reminder. The U.S. may be the best economic team on the field, but it can't play the game alone. For Nightly Business Report, I'm Steve Leisman.
Let's turn now to Jim Paulson for more on the financial markets. He's Chief Investment Strategist at Wells Capital Management. Jim, welcome back. Let's talk a little bit about Europe, which was just sort of sketched out there in Steve's report. Is Europe doing all that well or not very well? And if so, how worried should we be?
Well, it's certainly not doing very well. As the report suggested, they're probably growing somewhere between 1% and 2%. Whereas the U.S. is probably 3% or a little better. So there's certainly, the thing about Europe is they are following behind the recovery that the United States has because they were late in policy stimulus where the U.S. was early. And so, if you think back a couple years in the United States, we were still having periodic returns to debt crisis fears, and we were suffering from very weak growth that couldn't get going. And I think that's what Europe is experiencing now. But I do think they've made progress, Tyler, and I think they're going to continue to make progress the rest of the way in.
So are American investors right to be worried about the global economy? And also I want to add on to this, what do you think about what Carl Icahn said today, that time to be cautious about stocks? So what do you think about that?
Well, I thought all year, Susie, that the S&P 500 would maybe work its way up towards 2,000 this year, and then maybe struggle in the second half of the year. And I still sort of think that. I think that better news coming off Main Street in the United States, better than expected economic reports, has pushed the stock market higher. But I think in the United States, what's going to happen is we're going to find out with continued good news in the United States that we're going to get more worried about inflation pressures and interest rate pressures, and is the Fed pulling away? And is that going to start to maybe create some turbulence for stocks? So I think it is time to get more cautious. It's just that I think over the next several years, the stock markets across the globe might still go considerably higher. So I think one of the worst things you could do is worry too much about a 10% correction and miss the next 50% rise over the next several years. So I would get cautious, but rather than pulling away from the stock market a lot, I would prefer just to keep an overweight in equities, but diversify it. Move some of it out of the United States, move some of it to more defensive sectors.
Yeah, let's talk a little bit about that. I mean, you have been a very strong bull historically over the last year or so, but now U.S. valuations are something like 18 times earnings.
Right.
If you argue to diversify, where, and that would suggest that you like some non-U.S. markets and their values better than you like the U.S. one right now.
I do, Tyler. I would go offshore with a bigger amount of my equity exposure now away from the United States. The United States has beat everybody in the last couple of years. It's solidly beat the emerging markets, but it's also solidly beat most of the international developed markets as well, meaning that their relative values have improved. And I would go and take advantage of that. You can't often find value without some issues. And so the reason there's good value in Europe is because they're not growing as fast. Same thing with Japan, for example. But what that gives you by going over there is you can diversify away from the economic cycle. You can go to something that has at a different place in their recovery than the United States is. They're not worried about their policy officials tightening in Europe and Japan, for example, like we are here. I also like Canada and Australia because I think if we have more inflation fears here in the United States, we're going to drive commodity prices higher, and those commodity-based resource markets might lead the world market for a while. And then lastly, I would point out the emerging markets, Tyler. Right. As you said, we're selling at 18 times earnings here. They're selling at 13.5 times earnings. And even if they slow to 6 to 7% growth, that's still going to be twice the growth rate on a sustained basis that we can deliver here in the United States.
Jim, thank you very much for being with us. Jim Paulson with Wells Capital Management.
Okay, an update on some economic news here in the U.S. as to mortgage rates. They inched up a little bit last week. Freddie Mac says average rates on a 30-year fixed loan rose to 4.15% this week. That's up from 4.12% a week ago. On the 15-year mortgage, it rose to 3.24%. Current rates are a tiny bit lower than they were the same time last year.
So mortgage rates are attractive right now, and home price gains are easing. And even employment is improving. So why aren't more people buying houses? because they can't afford to. Our real estate reporter Diana Olick has the details.
Home prices are no longer rising as fast as they were last year, but they are still higher.
I think a lot of buyers and sellers are still trying to figure out what reality looks like.
97 of 100 metro housing markets surveyed by real estate website Trulia still showed year-over-year price gains, the most since the housing recovery began. Also, asking prices by sellers in June rose at their highest month-over-month rate in 16 months. Wage increases are nowhere close to that.
With prices rising 8%, it's ahead of wages, which means affordability is getting worse. Now the question is, does getting worse mean the same thing as bad?
Polco claims affordability is still slightly better than historical averages, but today's potential buyers are saddled with higher student debt and facing a tougher mortgage market.
I think a challenge is down payments for sure, having the cash to be able to put down 20%.
The Federal Reserve has taken note of the sluggish housing market, suggesting that persistent structural changes in housing demand were pushing more people to rent. Real estate agents are now saying sellers are more out of touch than ever with what buyers can stomach. In May, 40% of home sellers surveyed by Redfin said they plan to list their homes above market value, even though home sales were down 9% from a year ago.
Sometimes sellers are the last to know that prices may be stabilizing a little bit or that the increases you were expecting aren't necessarily carrying through.
There may still be too few listings for sale, but given the higher prices, it is becoming less and less of a seller's market. For Nightly Business Report, I'm Diana Olick in Washington.
Just a few years ago, cash-strapped Americans would pay their mortgage first, and then their auto loans, and then their credit card bills. Well, not anymore. The American Bankers Association says the share of credit card holders paying off their balance in full was the highest on record, according to the latest data. And late payments hit a 23-year low.
Up next, how data breaches like the one at Target last year are creating a growing demand and opportunity for the insurance industry. It appears Washington lawmakers are moving closer to a compromise on President Obama's request for nearly $4 billion in emergency spending on the border crisis. Any deal would likely include policy changes to expedite the return of tens of thousands of children who've been streaming across the U.S. border with Mexico and send them back to their home countries.
It's being called the only must-pass legislation on Capitol Hill, the Transportation Highway Bill. And now Senate Finance Committee leaders have agreed on a nearly $11 billion plan to extend construction funding, closely matching a plan from House Majority Leader John Boehner that includes changes in pension taxes and customs fees. John Harwood joins us now from Washington with more on this bill making its way through Congress right now. John, is this just a stopgap measure? What's your take on it?
Absolutely, it's just a stopgap. This is not just must-pass legislation, Susie. It's must-pass soon legislation because the Highway Trust Fund, financed by the gas tax, begins to become insolvent next month. So they need to be able to have some revenue to at least extend projects that are already underway, at least temporarily. Both of these bills would extend the trust fund into the middle of 2015, but only until the middle. These programs are typically authorized for 5-year periods of time, but they've come up because there's so much difficulty coming up with ways to finance it with a $10 billion package on the Senate side, similar package on the House side to extend it to mid-2015.
Why is this sort of short-term stopgap solution so endemic in Washington right now?
Tyler, as you know, the two parties are incredibly polarized and divided. The larger or longer a solution to a problem becomes, the more expensive it is, and the more money that either has to be cut from the budget if you're looking from a Republican perspective, or increased in taxes from a Democratic perspective. So what tends to be the compromise default is a path of least resistance, the smallest possible for the shortest period of time. It's not a great way to do business, but that's about the only way that can work right now in Washington.
Speaking of business, where does this leave American businesses? They could really benefit if this bill passes.
It leaves business uncertain, Susie, across a range of fronts on the highway bill, construction projects, on the Exim Bank, which is something that is at risk, vulnerable in the Congress, even though Democrats support it. Some Republicans don't. On tax extenders, which typically get the things like the R&D tax credit get extended for a very short period of time. And on immigration, we don't have a solution there either. Business wants one.
Absolutely. All right, thanks a lot, John. John Harwood reporting from Washington.
The White House is coming out swinging against Republican efforts to make a business depreciation tax break permanent. Officially known as bonus depreciation, the tax break lowers federal tax bills by letting companies deduct half the cost of certain equipment purchases up front instead of depreciating the gear over several years. Critics say making the break permanent would cost Uncle Sam nearly $300 billion in revenue over the next 10 years.
Verizon sees a dramatic increase in subscribers in its second quarter, and that's where we begin tonight's Market Focus. Almost 1.5 million customers joined Verizon, up from the first half of the year. Verizon's tablet and smartphone businesses also grew, and the company's CEO sees that trend continuing throughout the year.
We think this is going to be a great quarter for us. We'll have our full results on the 22nd of July. But we added over 1.4 million subscribers, post-pay net adds. We had record tablet growth. We had very strong smartphone growth. We had very good churn, and we delivered margins that were consistent with what we've done over the last several quarters. In addition, we're going to expand our wireline margins, which is a commitment we've made to our investors. So second quarter is very strong for us, and I think it's an indication that the industry is very strong.
Verizon shares rose 1.5% to almost $50 a share. Lumber Liquidators cut its earnings outlook for the year, citing reduced store traffic. It also said fewer people are buying homes this year than in 2013, while others are holding off on renovations. Investors bailed out of Lumber Liquidators, driving the stock down more than 21% to $55.25. Other home improvement retailers also fell. Home Depot was the worst performing stock in the Dow, falling more than 1.5%. Lowe's also down by more than 1%. After the bell today, Gap reported that its June same-store sales fell 2%. Its Gap and Banana Republic stores suffered the most, with sales down 7%, but its Old Navy chain performed well with an increase of 7%. Shares fell initially after hours, down about 1%. During the regular session, the stock was also down 1% to $40.97. It was a different story for Costco, though. Sales at the wholesale retailer were up 6% in June, topping analyst estimates, and that's thanks to higher fuel prices. Costco shares edged up slightly to $118 and change. Tyler?
IBM is betting big on chips. Big Blue announced plans to invest $3 billion over the next 5 years in computer chip research and development, hoping to revive slumping sales in its hardware unit. Shares of Big Blue down a little bit. 187.70 was the close. Oil giant ConocoPhillips upping its dividend nearly 6% to 73 cents a share. The payout will be made to shareholders in September. Investors didn't seem too pumped, though. Shares were off slightly. 85.67 is where they finished. And Boeing doesn't see demand for its jets slowing down anytime soon. The company is expecting to sell now 37,000 planes worth more than $5 trillion over the next 20 years, up from its previous forecast of $4.8 trillion in sales. The main driver of that growth is airline demand for smaller passenger jets. Despite the news, shares of Boeing flat at $126.79.
Amazon.com gets scolded and sued by the Federal Trade Commission for billing parents millions of dollars of unauthorized purchases by kids. So-called in-app purchases are goods and services you can buy once a mobile app has been downloaded. Now, the FTC has been pressuring Amazon to make changes to its app store, like getting a parent's permission before buying something. Amazon called the lawsuit, quote, deeply disappointing, and says it's already refunded unauthorized purchases made by kids. Earlier this year, Apple agreed to set tighter controls and paid at least $32 million to reimburse customers.
Another cyber attack on the U.S. has been linked to Chinese hackers. The New York Times reports that hackers in China broke into a government personnel database, apparently targeting tens of thousands of federal workers applying for top-level security clearances. With Target stores still reeling from that massive data breach last year, it's clear that cybercrime is a growing problem, and that means growing demand for the insurance that protects against it. Mary Thompson takes a look at the small but expanding market for cyber insurance.
In the city that never sleeps, one staffing company bought something it hopes will help its owners and clients sleep better.
Our clients were talking to us about it, they were asking us about it, and in order to prevent kind of being behind the 8 ball, we felt like we wanted to be really proactive and go ahead and get the insurance because we knew it was something that was important to our clients, and then of course it was important to us as well.
The insurance Clarity's head of operations Elizabeth Wade is talking about cyber insurance. Clarity is one of a growing number of firms adding this layer of financial protection should their computers or those of their vendors or suppliers get hacked or hijacked by a computer virus.
Up until now, the growth has largely been driven by what I would describe as data-rich industries, so retail, higher ed, financial, even tech and telecom. But with the expansion of coverage, with the growing awareness, we're seeing other industries come into play that have never looked at cyber insurance before. Construction, power and utility, manufacturing.
Bob Parisi works for Marsh USA, an insurance broker owned by Marsh & McLennan. Parisi says Marsh's first half sales of cyber insurance this year are double those of 2013. Here's why a company would want cyber insurance. A study by McAfee puts the cost of cybercrime to the global economy at $445 billion a year. Cyber insurance would cover some of those costs, including business disruption, legal and crisis management costs, costs to investigate the breach, and the cost of notifying customers, which is mandatory in most states. New regulations are a factor behind the growing demand for cyber insurance, along with high-profile breaches like the one at Target. This helped to bring in new clients and prompted existing clients to buy added coverage. Cyber insurance is a fraction of the policies that have been sold here in the U.S. by the likes of AIG, Travelers, and Marsh. But it is a product Parisi says holds great promise.
There's nothing that indicates that the growth is going to be anything but increasing.
A market growing to protect against a growing problem. For Nightly Business Report, I'm Mary Thompson.
Coming up next, the doctor will see you now, but you might need your computer or maybe a tablet for the appointment. We'll tell you why.
Crumb's Bakery may not be falling apart after all. Shares of the chain skyrocketed 1,300% today. You heard me right, after news that a group of investors, including entrepreneur Marcus Lemonis, star of the CNBC program The Profit, are preparing a bid to save the high-end cupcake shop. We told you on Tuesday that the company shut down all 48 of its stores around the country following years of losses and declining sales.
Unilever is slimming down. The consumer products giant, which makes Lipton tea, ragu, pasta sauce, Dove soaps, among other items, is selling its Slim Fast Diet Foods brand to a private equity firm. No terms disclosed, but the sale is part of Unilever's efforts to concentrate on its high-margin personal care division.
What if you could see your doctor 24/7? Now, thanks to new technology, you can, online. So-called telemedicine has been the next big thing for years, but insurers and employers are now embracing it in a major way to try to cut costs. Bertha Coombs has the first of our two-part series.
Lindsay Molina had a lot to do before the holidays and was coming down with an infection.
I just needed to see a doctor and get what I had taken care of so I could move on with my life.
She logged on and talked to one online at work.
She was able to treat me, and then on my way home, I picked up a prescription that she sent to my pharmacy.
Marvell Technology signed on to insurer WellPoint's Live Health Online this fall. But even in the heart of Silicon Valley, it's been a tough sell.
We've had a slow uptake in convincing people to use the service, I think because it's such a new idea.
The chip firm is hoping the $49 online visits catch on.
It can potentially be a huge cost savings. If you go see a regular doctor, your cost is anywhere from $150 to $200 for an office visit. It's a big, big difference.
WellPoint launched the service last fall as part of employer plans, as a way to help them save money and time.
it often can replace an emergency room, urgent care, or retail clinic visits, which purely from a price standpoint are higher.
Now it's making an even bigger bet on the technology with live health kiosks that include tools to measure vital signs like blood pressure and a dermatology cam.
It looks to me to be a benign mole.
For a fraction of the cost of a worksite clinic.
There's a medical record that's generated. If a prescription's written, it's a part of the visit and documented. We really think that it's a differentiator that your health plan is also integrated with this, so it's paperless.
Insurers like WellPoint have embraced telehealth in part because of the Affordable Care Act. Now that they have to sell to individual members and marketplaces, they want to be able to offer them more affordable and consumer-friendly options.
Have you checked your temperature?
They're also rolling out live health for the individual market, touting easy on-demand access for the same flat fee.
So how do you make it work, charging $49 for that?
Let's just say it's an investment so far. The future in our business is about having relationships with consumers and being a trusted source for them.
Once you get them over the tech hurdle, that is.
You just got to do it once, and then you get the concept.
Bertha Coombs, Nightly Business Report.
Actually sounds pretty cool.
Sign
But that'll
me up.
do it. Sign me up. That'll do it for Nightly Business Report for tonight. Thanks for watching. I'm Tyler Mathisen.
And I'm Susie Garrett. Have a great evening. Tyler and I will see you right back here tomorrow. I'm Susie Garrett with a Nightly Business Report news brief. Stocks on Wall Street plunged right out of the opening bell today following a big sell-off in Europe on worries about the financial health of a big Portuguese bank. But after reassuring words about the strength of the U.S. economy, stocks made a big U-turn. The Dow lost 70 points, the Nasdaq off 22, the S&P slipped 8 points. Congress is close to a compromise deal on the president's request for nearly $4 billion in emergency spending for the immigration crisis. The Federal Trade Commission is suing Amazon for billing parents millions of dollars for unauthorized purchases by kids. And a record number of credit card holders are paying off their balance in full, while late payments hit a 23-year low. Be sure to tune into Nightly Business Report right here on your public television station.